You're listening to The Practical Wealth Show with Curtis May.
All right, guys. Hey, welcome to The Practical Wealth Show. I am excited. I have a meeting with a gentleman I met about 6, 7, 8 years ago. And he's got a great book that we're going to talk about today. So I want to introduce you guys to Mr. Bryan Bloom. Bryan is a financial advisor. He's a CPA for over 35 years. And he's got a series of books that he's authored, the series of confessions of a CPA, right? He's also a father, a grandfather. He's been married 40 years. I'm at 23, so I got a little while to go to catch up. Lord willing,
You can do it.
We'll do that. We're going to do it. That's what we're shooting for. And he has 2 daughters. I have 3 daughters, right? 3 granddaughters and a grandson, and a granddaughter on the way as of this, the bio he gave me. So, and he doesn't believe in retirement. Retirement is spreading this legacy of this information that people have got to get out, because people perish for lack of knowledge, right? And so we both have a heart to get out there. And it's funny, a lot of this stuff you talk about, you discovered, Bryan, and that's what I started to discover. And it's like, I'm mad because there's so much misinformation out there. And so, Bryan, welcome, excuse me, to the Practical Wealth Show.
Well, thanks for having me, Curtis.
Put my virtual thing back on. My office is messy back. So, all right. Right. So, Bryan, tell him what I didn't tell him. Catch me up. What were you doing before, and how did you make the transition, and how did you start to just uncover some of these, I won't say secrets, but secrets or that you've discovered to unfold? I want to go into a few of them today that you think are big ones.
Sure. It was definitely personal discovery. And I started my traditional career getting my education through 4-year university, got a master's degree, and on top of it, earned my certified public accountant credentials and went to work as a CPA for a public employee retirement system. So it was just fortuitous in this first job that my emphasis for the rest of my life would be retirement planning. So in that perspective, I was helping public employees of universities, community college, plan their retirement based on what the state provided. So I helped them understand benefits. And of course, in that situation, they had no choice in regards to participation in the plan, nor did they have the choice of whether they wanted to put their money into the plan before taxes or after taxes. I didn't know that there was significance in that when I first started, but I figured that out later on. From there, I moved into being a third-party administrator for 401k plans, profit sharing plans. And in that situation, I learned how to skew plan design to benefit the owner of a small company and how to make their dollars work best, but again, on a tax-deferred basis. Now, in that period of time, I bought my first life insurance contract as a favor for a college friend of mine who was recruited into the life insurance business. And I bought my first life insurance policy from him and paid my premiums and kept going my merry way. Later on, I bought my second policy from another friend of mine who began to expose me to some of these things that I've come to embrace today, but I didn't really get it. But again, an event that occurred right after I bought that second policy, the head gasket in my vehicle blew out. I needed to either do an expensive repair or buy a new car. And of course, at that time, I had we were just expecting our first child. And so I had to trade in my burned out bachelor car for a minivan. So it was incredible slap, to come to the reality here. And I immediately went back to my advisor and I said, cancel that policy. I can't afford it. I now need a car payment. And what I was going to put in that policy every month has got to go to make the car payment. He said, wait a minute. Didn't you tell me about a life insurance policy that you purchased back when you were in college? I go, yeah. He says, bring it in. So I brought it in. He showed me how to buy the car from my death benefits of that policy. He said, here you go, buy the car. We're going to take a temporary reduction in your death benefits by lending you from the company the company's money. And if you die tomorrow, they'll just reduce the death benefit payable to your wife by the value of the car. Car plus a net death benefit. So she's not out anything. And he says, and you can pay it back whenever you want to. You don't have to, if you want to skip a year, if you want to skip a month, you don't even have to pay it back. I said, oh. And he said, and of course you can keep the policy you just purchased as well. I go, okay, great. So there we go. Of course, now as CPA, do I like debt? No. And so I paid that sucker back so fast you wouldn't even believe it. I paid it with money I didn't know I had, and I got that loan paid back. Now that was my first introduction to what I do today, is helping people understand how money really works and the power of using other people's money and letting my money continue to grow uninterrupted. Einstein said the eighth wonder of the world is the miracle of compound interest. Well, it's not. The eighth wonder of the world is the miracle of uninterrupted, or it doesn't work. Otherwise, everyone listening to this podcast would be retired by the time they're 50 or 55 years of age.
That's actually the first chapter in the book, right?
Yeah.
Which is the talk about that. Then let's you said two things. So, and I want them to hear it. You borrowed against the death benefit, which is I say it a little bit different. I want to make sure because the cash value is the present value of the future of the death benefit. So you borrowed against the money, the cash values that you saved in the policy. I just want to explain that. No, okay.
I did not.
Go ahead.
I did
Okay.
not. So the death benefit of an insurance policy is nothing more than your premiums plus the insurance company's guaranteed dividends projected to age 100.
Right.
It's just the future value of all the money at age 100. And of course, the benefit of a life insurance contract, if you die before the age of 100, you're
Right. So let's back up. You purchased a
money.
permanent policy, a whole life policy.
Yes, a permanent whole life policy. And that's what makes this whole idea, Curtis, of leaving a legacy so important, because these whole life policies have been around for 150 years.
Yes.
And they come and they go. And it's like, folks, we got to get this figured out and keep the use of a permanent life insurance policy high and not let it lag off and it come into disfavor, because I've never known it to be in disfavor. It's always been a favorable financial instrument. The problem is nobody knows how to use it.
Right.
So let's talk about that.
Yeah.
When we put our money into a life insurance contract, the life insurance company puts in their dividends and we create this thing called cash value. And it begins to grow and it grows and it grows. And what most people don't understand is that they can use the cash value as collateral to borrow the insurance company's money that is collected from your death benefit when you die. So you're not borrowing your own money.
Right.
A lot of advisors get that wrong. They say, well, use this life insurance contract because then you can borrow your own money. I go, why would I want to borrow my own money?
Right.
Doesn't make any sense.
That's right.
So you borrow the insurance company's money and they charge an interest rate. Ooh, careful. They charge an interest rate. But remember, your cash value is also earning a dividend. Your cash value is in certain contracts is not held hostage to a loan. Now, this is where you got to have the right advisor.
Right.
Because some insurance companies will hold your cash value hostage if there's a loan outstanding and either give you no dividend on that loan, that the money that represents the collateral in the loan, or the reduced dividend. Somehow they'll offset it. So you want a company that's not going to offset the dividend because there's a loan outstanding.
Right.
And of course, the beauty of all this, Curtis, is a loan for the 108 years the Internal Revenue Code's been around is tax exempt. Now, this is something we can get into a little bit later, but there's a difference between tax-free and tax exempt. See, so I focus more on my clients' retirement, and I want to teach them how to get off the radar screen of the IRS for income tax purposes in retirement. And it all comes from taking loans against the death benefit. It doesn't have anywhere to go on the tax return.
Right.
Nowhere to go. Now you can save into a Roth IRA if you want, and it's tax-free, but you still get a 1099-R. for it at the end of the year. And you still have to report what you took out on the tax return. It's just that none of it's taxable this year.
But you still have to report it. Interesting.
They got
Okay.
my name.
Yeah. That
my-
you listen, that when I always tell people, I ask people in the future, do you think tax will be higher, lower, the same? They go, oh, I'm not sure. And then I'll pull up, usdebtclock.org
Yeah,
and let's look at this. I just let it run. And you
yeah,
tell me
right.
what could happen. I won't say what's going to happen, but
Yeah. COVID has given us a new way to say that. Curtis, if what our country's gone through in the last 2 years, just think about that. Now, based on that, do you think our government's going to need more money in the future or less?
absolutely more. That's right.
How can you say they're going to need
Right,
less?
right. You're spending money we don't have. They're sending people money. Yeah. And so
My-
how do you protect your personal economy? You got to think
Right.
macro. I tell people you got to kind of, if you know what's going on, you'll know what to do. And so you really need to know what's going on so you can
Right.
adjust and protect yourself. So I want to bring that out. Thanks for sharing that. And then go back to, so let's talk about your first discovery of the fallacy of the miracle of compound interest.
Yeah. Well, if you graph, you find out that every time you take money out of a compounding account, it never gets back to where its potential could have been because the money was out for a period of time, even if you pay it back.
Mm-hmm.
Now, I know that when I take a loan from the bank, I have to pay that back. Now, if I take a loan from myself by taking money out of my bank account, I know some people will put it back, but it'll never get to its potential.
Right.
I know a few others that will not only put the money back, but they'll put it back with interest that they didn't earn because the money was out. Now they'll get a little bit closer to their potential.
Mm-hmm.
I know of nobody who puts back the principal, the interest, and the compounding they missed. And that's the only way to get back to the full potential. Well, guess what? If you never take the money out of your account, but you borrow someone else's money,
Mm-hmm.
you never get off the potential curve. And you will experience the miracle of compound interest. Now, it just so happens that life insurance is so flexible in that you don't have to pay it back. You can pay it back. You can pay it back in lumps. You can do whatever you want. And doggone it, if you default on it, i.e., you die, no big deal. They just net it from the death benefit.
Right. That's right. It's like a financial Swiss Army knife that
Oh,
really should be the core of one's what I call personal economy.
yes, it's the foundation.
Yeah.
It's the foundation. And there's lots of uses for it. I use it in a form for retirement where I call it all in.
Mm-hmm.
I can advocate a position where you should have all your retirement money in a life insurance contract and take loans for the rest of your life. And you'll never have to file an income tax return. Now that's one use.
Right.
Okay. Now there's another great use for it, and that is to utilize not only the life insurance, but also other assets if you have them. And I call this the salt and pepper approach.
Okay.
Steak is good as steak, but add a little salt and pepper, and it's really good, right? But so in this situation, an investment, you may deem an investment to be a good thing to hold. But if you add life insurance to that, just like salt and pepper to a steak, the
Mhm.
investment gets even better because you can spend it twice. Well, Brian, what do you mean? You can spend it twice. Well, if you got $1 million in some mutual fund somewhere, you can aggressively aggressively spend that down to next to zero as long as you don't go below zero before you die. Because as long as you've got a few bucks left in that investment, at your death, if your death benefit's worth $1 million, it gets plowed right back in. And now your spouse or your heirs get to spend $1 million a second time.
Right.
But that's the value of life insurance in the form of salt and pepper.
Right.
So there's lots of ways to use this stuff. And like you said, it's a Swiss Army knife.
That's fantastic. And it's huge that because I was just talking to a client, and it's like, well, I've wanted, they conflate saving and investing. So they store their liquidity in ETFs. I said, well, that's not saving. Okay. First of all, but that's where their money is. And how do you, when you need it, what do you have to do? You have to liquidate, you have to cash it in. And so you're still selling the shares,
Right.
you know,
Interrupting the compound.
interrupting the compounding,
Right.
or the growth with, and they don't see, it's like the opportunity cost, like it's these little financial concepts that are not taught. Like we're taught half of them, that gets us to play the game. But, what's our mutual friend says, we're being caught up in people that, what does Lynn say? That create the transfers, control the outcome, and give you basically enough knowledge to play the game. But playing the game transfers our wealth to these other institutions. So you can play the mutual fund game, but the fees and the, all that stuff transfers to them. And we don't even know how we're losing money, but we're losing money.
Curtis, who wins the game of Monopoly?
The bank or the
people who know the rules.
People know the rules of the game, right?
Yeah.
Right. It's hard. I always tell you, it's hard to win a game you don't know the rules.
That's right. You got to pass go.
And most times we're either playing by the wrong rules, or we don't know the rules at all. That's the why your book is so important.
Right. Or we're playing with the rules they want us to know.
Yeah. Yes.
Why should you follow the financial entertainers on radio and TV who tell you that you should defer as much of your taxes as possible and pay off your house as fast as you can? I mean, that becomes common knowledge, and maybe that's good for common people. But if you think you're common, you probably aren't.
Right.
I would say, of people who live in America, probably 75% of them would consider themselves common. But if you take a look at the income dispersion in the United States of America, you'll find out that half of the people that live are maybe common, maybe less than that. But if we looked at your income in comparison across the board, you would have to look at that and go, wow, my income's really extraordinary. And if your income is extraordinary, and you'll be surprised at how low that is. If your income's extraordinary, what are you doing following common sense rules?
Exactly.
That these radio entertainers throw at us all the time. You need a strategy. You need to think outside of the box. And Curtis, our role as financial advisors, if someone's uncomfortable because we ask them to move outside of their box of comfort, our role is as educators and make their box bigger, and help them understand the rules that they have not been taught. That's what Confessions of a CPA is all about. Why what I was taught to be true has turned out not to be in my own life.
And you're, as a CPA, that's because everybody defers to them, but you don't know everything just because you have those 3 letters behind your name. And so that's, if you weren't into self-discovery, you may not have known a lot of this stuff.
Well, for instance, most CPAs are going to tell you can live on 60 to 70% of your income in retirement. Well, if you can live on 60 to 70% of your income in retirement, number one, why aren't you doing that now?
Right.
And I don't know anybody who can live on 60% of their income that they can't live on today. How, everyone on the date of their retirement in their CPA's office, when you're told this, you should come in with a bouquet of helium balloons. Okay. And the CPA should tell the spouse that's not holding the helium bouquet of balloons to pop 40% of those balloons, because each balloon represents your standard of living today. Pop 40% of them, because that's what your standard of living is going to be like tomorrow. Following my advice. Well, I don't think anybody would do that. They'd be running from the CPA's office.
Right, exactly.
But we don't question them because they got those 3 magic letters behind their name.
Yeah, you gotta. And so what's the solution for that? Like a lot of people don't have the confidence to push back against experts.
Find an expert. I mean, don't just assume someone knows what they're doing. I mean, it if you're listening to this podcast right now, be looking for someone like Curtis, like myself, like people that advising never heard this stuff before. That's a good way to interview the CPA or the financial advisor. What do you believe about compound interest? What do you tell me about taxes? How much can I live on in retirement? What percentage of my current income can I live on in retirement? If you hear anything less than 90%, run,
Right.
because security's going to last forever too.
Yeah, you're right. They're living on 105, right? So
Yeah.
now, so yeah, that's
And
that's
and the other thing, Curtis, don't be afraid of terms. Okay. Number
Mhm.
one, life insurance. Oh, that's a dirty word, right? So is a reverse mortgage. But don't run away from those things without listening to them and understanding what role they might play.
Right. Right.
Don't let someone cast it out of hand and say, "Oh, I'd never do that."
Right. I didn't
Yeah.
take my house, and I always tell people it's never the product, it's the strategy, right?
It's
And so it's the
strategy,
strategy. Products are just tools of implementation. So,
right?
it's a tool. So it's like, oh, I don't like term, I only like whole life. That's like saying I don't like screwdrivers, but I love a hammer. I mean,
Right.
it doesn't mean anything.
No.
And you have to, but they work in concert. And so you have to kind of, part of this, Brian, I always tell people, look, you have to read some stuff. Like I give them homework of a recommended reading list because you have to keep your own counsel. It's your money,
Mm,
right? And then you've got to, that way, because you have to be able, so if you say, well, all right, I'm buying this life insurance. So I had a client, give case in point. So she was putting a decent amount of money, I mean, about 10 grand a year in premium. And then she talked to this guy that was teaching her how to do apartment buildings. And somehow that came up. So, why are you doing that? Why don't you just get term insurance and keep it moving? Now, this person came from Goldman Sachs, so their whole world is Wall Street. So, but she had been around me long enough and had done enough of the homework that she just kind of brushed it off because she was strong enough. And I made sure she was rooted enough in the philosophy that she could, use him for what he was teaching her, but understood that she knew what she was doing over here. And guys, that's how you kind of got to be.
right. Right.
And because you got to figure what's your plan and what will get you from point A to point B.
Right.
What's another big that you've discovered, that one of your favorite ones that you find? Give me a few of those that
Let's just stay on the one that you just brought up. I mean, think of the absurdity of the counsel that person received to just buy term insurance and invest the rest. Okay.
right.
Number one, um, term insurance pays a death benefit less than 2% of the time.
Mm-hmm.
Gee, hmm, that just means you didn't die on time, right?
Right.
So the extreme unfortunate has to happen for term insurance to ever really work. Okay. Now take the invest the rest. Do you? No.
No.
People don't invest the rest. So that becomes a problem. Now assume you do. Let's say you bought the term insurance and you invested the rest and you deemed that you needed $1 million deal during your earning years. If you died early, you needed $1 million for the family to continue on. And in retirement, you needed $1 million to continue. Now you're on the eve of your retirement and you take your spouse out for dinner, celebrating your retirement, and you say to your spouse, honey, we did it. It's amazing. We can now retire. We've got our $1 million right here. First thing in the morning, I'm going to terminate my life insurance contract because we don't need it anymore.
Right.
Now, how long do you think you're going to live through the night? I'm being facetious,
Mm-hmm.
but
Mm-hmm.
ridiculous,
Mm-hmm.
right? Because you got it. So I'm going to cancel my insurance. And guess what? The insurance company doesn't refund all those premiums that you paid. Now, take all those premiums that you paid all the way up to 65 and calculate the future value of those premiums to your life expectancy age 85.
Mm.
That's how much the term insurance robbed your retirement. Now take the same amount of money and calculate the featured value of all those premiums to age 100. That's how much the term insurance costs your kids.
Mm-hmm.
If you do it right and you purchase permanent life insurance, you get it all.
Right.
But
Right.
again, that's going back to the miracle of compound interest.
Right. Because you have to, it's so much stuff. So you got to kind of pull this stuff together because one of the things I'll tell people, I said, listen, I said, what did I tell them? I said, listen, if you had homeowners insurance, if you paid your house off, would you drop your homeowners insurance?
Right.
Right. If your house was worth 300,000, you had 300,000 of cash, would you drop your homeowners insurance? Most people still will go no. Well, what's the difference? Right.
Right.
And because now if you have insurance, to your point that you made earlier, that that frees up that 300,000 to spend or do whatever you want to do with it because you transferred the risk to the
Right.
insurance company.
Some people have more life insurance on their appliances than they have on their loved ones.
Yes. So, and so yes, it's and the industry does it to themselves, but it's what happens is because only 2%, and here's the thing, people will tell you to drop your insurance at retirement. So because I tell people, look, if you're 45, what's the odds of you being here at 65? Pretty good, right? But between 65 and 100 or so, the odds of you dying are like 100%. And
Yeah.
wow, 100%, right? I only know one person that kind of got around that, right? So they didn't that, and that's another story. All right. But what happens is why would you drop it for 100% certainty? But there's whole organizations that's their philosophy. And here's the other thing, because I've been doing this like 35 years. I don't care if you did invest a different, because my clients, I was like that. I was a buy term investor difference guy. And my clients did invest a difference. And I would look at their stuff 20 years later. They didn't have enough money where they didn't need insurance anymore. Once you understand, and they say, buy, no, this will speak to, I want you to speak to this. So even if you buy term investor difference, and they'll tell you to will fund your 401k or qualified plan or your IRA, then you could lose past a lot of that money in the transfer to the legacy. Speak to that. For how much money are they losing? Less to the wife, but when you get it to your kids, you could lose over half of it to taxes or something like that. I don't want to exaggerate, else you correct me. But
No, that's fine because there's all kinds of loopholes through that, through all of that. Fortunately, we don't have the stretch IRA anymore.
mm-hmm.
And I say fortunately, and a lot of people go, "Oh, that was horrible," But fortunately, the stretch IRA is gone because the stretch IRA would stretch out the debt on the taxes not paid for a really, really long time. And like we discussed earlier, do you think taxes are going to go up or going to go down?
Mm-hmm.
Well, guess what? A qualified plan, 401k, 403b, IRA, anything you haven't paid your taxes on is never passed to the next generation tax free. There is no step up in basis like there is in stocks and bonds at your death. The taxes you didn't pay, your spouse is going to pay.
Mm-hmm.
And your spouse is going to pay at single taxpayer rates, which are double joint taxpayer rates.
Mm-hmm.
And if he or she still has money in that account at their death, your kids are going to pay taxes at their rate,
Mm-hmm.
at their future rate.
Mm-hmm.
Now, fortunately, we got rid of it going on to our grandkids because our kids now have to liquidate the qualified plan within 10 years and get the taxes paid on it. I'm an advocate of paying your taxes today because I think they're going to go up in the future. Curtis, if you could have filled the backyard with a tank that would hold gasoline, when would you have wanted to fill it? A month ago or today?
A month ago.
A month ago. If you think taxes are going up in the future, when do you want to pay your taxes? Today or some uncertain date at some uncertain rate?
Today.
Today. I live here in Illinois. And in Illinois, we grow corn like you wouldn't believe. Now, if a farmer had their choice of paying taxes on the seed before it went in the ground or on the bushels of harvest in the fall, when do you think they'd want to pay their taxes?
I think they would want to pay it on the seed, like
On the
now.
seed when it's
Mhm.
fall, right?
Mhm.
So why don't we want to pay our taxes on our income today when taxes are lower? Why do we want to pay them sometime in the future when they're going to be huge? Now that's just the taxes.
Right.
Now you got to decide, okay, so you want to access that money before you're 59 and a half. Well, you're going to have a 10% penalty, right? Oh, and by the way, if it's in a 401k plan, you think the 10% penalty stiff? You got to quit your job.
Mm. Right.
That's a penalty,
Right.
right? Now, if you get all the way to 72 and you figure you don't need the money and you don't start taking the money out of the IRA or 401k, guess what the penalty is? It's 50%.
Mm.
That 50,
50.
50% plus the taxes due on the money you didn't take out.
Mm.
Now you live in California, you might owe more than you should have taken out.
Right.
Right?
Right. Right. That's a big consideration. We talk to people about transfers are your number one transfer of wealth, like your biggest expense. If you don't pay attention to them, and if you study wealthy people, it seems like almost every decision is to minimize current and future taxation. Like it's in every financial decision that they make.
Right. And here's the reason why my profession advocates that. Why would a CPA advocate that you pay as little as possible in taxes today? Because you've contracted with them on a year-to-year basis. So if they want to do your taxes again next year, guess what they're going to do this year? They're going to get your tax bill down as low as possible
Mm-hmm.
so that you rehire them next year. What you want is a CPA that will look at your taxes over the generations
Mm-hmm.
or your taxes at least over your lifetime,
Mm-hmm.
not
Mm-hmm.
not year to year.
Because it's a quick fix. Like it's like, oh, well, you owe this thing. Let's throw this money in a SEP, or
Yeah.
you're right. And that's like that because they're trained. All right, I'm a hero if you don't pay any taxes, but that's short term thinking because you're only postponing them. They're going to tax the harvest. You
Right.
know,
Exactly.
and it's hard to get. It was hard to get across to it's it's not impossible, but that's going to take some education on your part, listener. And that's why you got Brian and I here too. You got to get his book, Confessions of a CPA. Okay. So he's breaking this down to you from somebody that gets this stuff on both sides of the fence. This is fascinating, Brian. I might have to bring you on like once a quarter or something.
Hey, yeah, I love what I do and I want to leave a legacy. I'm not getting younger
Mm.
and I want people to carry this type of a message forward.
Talk about investing for the long term. One of your chapters is be a long-term investor. And so what is it that you thought about that turned out not to be true?
Well, this gets kind of mixed up a little bit with rates of return, but
Mhm.
you want to make sure you don't deceive yourself in being a long-term investor. Sometimes we fall in love with this average rate of return. And an average is merely adding up all the year-to-year rates of return and dividing it by the number of years. And life doesn't work that way. Life doesn't work that way at all. We earn what we earn. And so the actual rate of return is always less than the advertised average rate of return.
Mhm.
So again, it's got to be one of these things where we don't deceive ourselves. Now, be a long-term investor. I'm an advocate of not losing money. Okay. If I could keep you as a long-term client if all I did was sell you the winners and only tell you about the winners, right?
Mhm. Mhm.
But you see, if that's not how the real world works, your investments, they go up and they go down and they go up and they go down. If they go down 50%, they've got to go up 100 just to get back to where you
Just
used
to
to
get
be,
even. Yes.
just to get even. And if the market's going up, probably back down,
Mm-hmm.
you know? So being a long-term investor, if you can minimize the losses, so that's that you'll be dollars ahead. Because while everyone else is catching up to a market correction, you'll be marching forward.
Right.
So be a long-term investor, avoid the losses.
Right. And so that's key. And a lot of people don't understand that part. Like they'll say, well, my fund is back up, but it's up one like a 401k because you're putting money in it every month. But you really haven't made money because you're just getting back to where you were. And I think that you kind of gotta again have clarity of what's actually going on within this stuff. And I
You
think
got to
that,
pay attention to the dollars, not the percentages.
right. Because
If
math
you
is
go to
not
the
money.
That's right. You go to the grocery store and you try to pay for that bag of groceries with a rate of return. How are they going to look at you? Right? Like you're an
Crazy.
idiot.
That's right.
But if you
So,
come in there with cold, hard cash, that's what counts.
mm-hmm.
So
Mm-hmm.
would I rather have $100 or a 12% rate of return? Well, 12% doesn't cash at the grocery store. $100 will.
Right.
So you got to pay attention to the dollars, not the percentage signs.
Right.
And of course, the CPAs always talk, that we're trained to percent this and percent that and IRR and NPR, all these stupid rates.
Right. That's money. You can't
Money.
you can't eat equity, right? I want,
Right.
you need cash or dollars, because you need currency. You need to do what you have to do. So that's why we always tell people math is not money. So I don't care what I can share the average 25% and not make a dime. And there's a little somewhere, guys, I have a video called Actual versus Average where we talk about that.
Okay,
And
I can tell you how to
yeah.
average 25% and end up with less than you started with.
Yes, exactly. And that's good stuff. Oh, Bryan, I'm coming up on a time thing.
I'll come back again whenever you want.
Yeah, please. So tell them, how can they find out more about you, get the book, and where would you like them to go?
It's at Amazon. Type in Confessions of a CPA. Now I've updated that first book. You have to also type in Why What, because that's the subtitle, and you'll get the new book that way. So Amazon search Confessions of a CPA, and there's 3 books there. The one we've been talking about is the original work, Why What I Was Taught to Be True Has Turned Out Not to Be. The second book is the truth about life insurance, and it talks about life insurance as salt and pepper, like we talked about before. And the third one is the capital equivalent value of life insurance. This is more the all-in approach, and it's the proper way of calculating a rate of return that you would have to earn somewhere else to provide you with all the same benefits that you'd get in a life insurance contract. And we're talking upper teens.
Wow.
When you do this right.
Bryan, I'm behind. I gotta go back on Amazon. I got 2 more books. I have the one. I see the other one. So I gotta catch. So all right, are we just together?
One of those other 2 because they're biggies, or you can have an email, Bloom, BBLOO, and I'm at theamericagroup.com.
Okay.
And I'll send you books myself. I'll sign them for you if you want me to.
I will probably do that.
Okay, good.
Well, I know the author. I want to talk to the author. So listen, Bryan, thank you so much. I had this schedule. I had somebody like boom right up on it. And I should have left just like an hour and a half. We wouldn't talk an hour. We would talk an hour and a half with you, but I should have just not pushed them both together. But I definitely want to, if I appreciate you being available. I'd love to get you back on. There's so much wisdom in there. The last book, because that's the equivalent value. That's what people miss because they're so full. What's the rate of return? And it's not, that most people, I probably need, that's why I need that book, because I need to be able to, I understand it, but if I can't draw it to you, I can't explain it, then it's no good to that,
Well, it's a concept that has never existed before the writing of that book.
Okay.
It is revolutionary. No one else has thought the thought.
I will have that book before by the time we hang up. I'm gonna get it. I'm gonna get it in Kindle, but I want the real book, but I want to get it in Kindle because now I have this immediate gratification thing going on. So
It'll expand your bookcase.
Right. So Bryan, thank you so much. And guys, go out there, go pick up this stuff, read, all 3 of Bryan's book, and you'll get a lot of insight into some of these financial concepts that will allow you to keep more of what you make and become more efficient because you understand how money works. If you want to create maximum wealth, you have to stop losing money. You got to stop giving money away and create maximum efficiency first. Bryan, take us home. Give him some brilliance. 30 seconds of your brilliance.
Think outside of the box. Don't accept the status quo. You know, if you're going to do what everyone else is doing, you're going to get what everyone else gets. If you want something different, you got to think differently. You got to find the right advisor who can help you think outside of the box. Outside of the box is not so terrible. Find the advisor that will increase your box of knowledge to include this strategy.
There we go. And so I'm gonna end it with that. Bryan, thank you so much. And guys, go out there and make it a profitable day.
Thanks, Curtis.
All right. Thank you.
Thanks for listening to Practical Wealth. To access the show notes and resources, go to practicalwealthshow.com. To get your questions on the show, go to practicalwealthshow.com. This show is for entertainment purposes only. Before you make any investment decisions, consult a professional. This show is copyrighted by Practical Wealth. Written permission must be